Amrita, which part of the micro matters now for weak oil? Which part are you studying?
China, I would say that's the number one concern in the market and a big driver of sentiment, not just in oil, right, across asset classes. But if you look at our balances, we have, but even here, we've been talking about, despite the weakness in European and kind of US demand, it's Asian demand that's stronger. And our expectation has been that China will be recovering. Now, that's not quite happening.
What is the dollar dynamic? And I mean this in dollar pairs, like dollar Philippine peso goes out to new Marcos Jr. weakness as well. And there's other selected currencies. But even away from dollar, Aussie yen shows maximum Australian strength. What does that mean for hydrocarbons in the Pacific Rim?
I mean, look, that's happening because, again, Australia and other commodity producers are clearly benefiting from such high commodity prices. It is to be expected, and that also means that commodity importers, which is the vast majority of Asia-Pacific countries, they have that added whammy, right? Not just of high outright energy prices, but also weak exchange rates, which means the import costs are higher. But having said that, outside of China, demand numbers are still very strong. If you remember, I'm sure you've seen it, the US numbers for June got revised up by 700,000 barrels per day. Every week we've had media headlines and other analysts hyperventilating about, weak gasoline demand. And we keep saying the weekly EIA numbers are honestly worth not very much because of the amount of revisions that go on.
And John mentioning the airline travel as well there. And I look at this, Aussie yen is really at a rare place back 20 years, out 1.5 standard deviations strong Australia. That shows the swings that we're seeing right now.
Yeah, well, Aussie yen, you're capturing the commodity story, you're capturing the interest rate differentials, aren't you there? Amrita, someone's clearly celebrating in the background of your shot, so congratulations to them for whatever it is they're celebrating.
It's our 10-year anniversary. Nice. It's literally...
Lovely.
It's 10-year anniversary.
Well, congratulations to you.
Why,
Fabulous. Congratulations to you. I want to ask you about the end of December. When we get to the point where Europe is not supposed to buy any more Russian oil, how smooth can that be?
It's not going to be smooth at all, especially if we don't have clarity on the Iran deal. And for us, even if there is an Iran deal, the barrels don't really hit the market till January of next year. So this is going to be a very, very tricky time because Europe, or the EU particularly, has to get rid of at least another 1.3, potentially as much as 1.7 million barrels per day of Russian oil. And that is not going to be easy to replace because you've seen what's happened this summer when that volume of oil was still coming into Europe. Every single benchmark went to record highs in terms of the physical market, not necessarily the financial contract. Imagine another 1.4 on average we need to replace that. I'm not sure where we're going to get that oil from.